Hello everybody and welcome to our new strategic research video that will be dedicated to the natural gas in the US. Before I start, however, keep in mind this video is not investment advice, and if I'm gonna speak about specific financial instruments like futures, spreads, options, ETFs or individual stocks, it's always just for educational purposes. Originally, I wanted to do a video about a different topic, probably about the precious metals, because I think there is a more interesting opportunity there. But we dedicated a few articles on our blog to gold and silver already, so basically all the information is there. And the natural gas and the situation in natural gas is probably more important to analyze, because we received a lot of interest in natural gas recently, because at this time of the year it's a good idea to look at bear spreads. It's been historically a great strategy to buy bear spreads or enter bear spreads at this point of the year. So we decided to take a closer look. And I should also explain the title of this video. It will not be about trading natural gas in general, because it's out of the scope of this short research video. On the other hand, it also will not be about a specific situation in the short term, because I would like to talk about the longer term trading approach to the natural gas. It's true that it can be also applied to the current short-term situation, but the important thing is how to trade natural gas over the next few years. So let's start with this chart, which is term structure for natural gas. And the important thing is not the curve itself, but also the comparison between the current term structure and the historical curve. Therefore, I will show you, for example, this one. The red one is the 5-year average curve at this time of the year. And we can see an interesting fact, because the near end of the curve right now, the blue curve, is above the historical average, which means it's more expensive, while the back end of the curve is cheaper. Usually such conditions are associated with weather premium, when the market expects cold weather in winter, or on the other hand, hot weather during summer. But we are entering, or we already are in off-season, when the weather doesn't have as much impact. So it's rather surprising to see such a state of the market. This structure creates incentives for traders to look for bearish strategies, like the bear spreads I mentioned a few minutes before. And it's true that bear spreads have been historically a good strategy on natural gas, especially in the off-season, when there is or when the impact of the weather is low. On the other hand, it's critical not to miss the forest for the trees. Let's show not just the 5-year average term structure, but also the 15-year and maybe even the 30-year average curve. And you can see that suddenly the current prices don't look as high as before. On the contrary, the long-term prices have been, over the last 15 or even 30 years, much higher, somewhere between 4 and $4.5 when I take a look at the near end of the curve, which is much above the current prices below $3. But this information alone is not very useful because even though the market is cheap, it can stay cheap for a very long time. And the 5-year average is the proof, because you can see that the natural gas is not cheap just this year. It's been cheap over the last 5 years. In fact, I would say it's been cheap over the last 10 years, which is a very long time. So the fact that it continues to be cheap doesn't imply its price has to go higher immediately. It doesn't imply it has to match the historical prices, the long-term historical prices next year or over the next few years. Nevertheless, that's exactly what I expect to happen. I think the era of cheap energy and cheap gas is over. And I won't go into details because we already explained this very well in some older research videos, like the one from the one from the end of October, the ultimate value opportunity. And when I focus just on the natural gas, I would recommend you the video from March, Things Are About to Change in Natural Gas, in which we anticipated the changes that we witnessed this winter, like the explosive demand for natural gas in Texas and elsewhere in the US. So we've been well aware of the fundamental changes that you are witnessing right now. And we think these changes this trend will continue. And that's the reason why the prices you see nowadays are probably to be the thing of the past. Of course, there will be sell-offs and dips, but overall, I think the next 5 years, or the average curve for the next 5 years, will be much closer to the yellow and green curve than it is right now. Let's take a look at the evolution of the price of natural gas over time, which means a simple price chart. On the other hand, it won't be as simple here, because the most common way how to express the price of any commodity is through the continuous contracts, especially when you analyze longer-term history. But I think it's outright wrong here on natural gas, and the reason is that there are huge differences between individual expirations on nat gas. For example, the contracts from the winter heating season can behave very differently from the expirations in the off seasons. They are basically like two different commodities. And when you do a continuous contract, the individual contracts into the single time series are plugged in it based on either expiration or maximum open interest and other metrics. So you end up with a single price that is composed of many contracts. And as I told you, some of these contracts may behave very differently, in fact, as two different commodities. And that's the reason why I will analyze the long-term price of nat gas using the continuous prices for specific futures contracts. And I picked two options, two expirations. The first one is the August expiration. It's from the summer season, and the second one is the January expiration, which is from the winter heating season. So let's open them, and I will also add this one, and I will explain to you why later. So here is the continuous price for the August expiration. In fact, it's the bottom subchart. The top subchart is the statistical distribution for the chart below. It's for the same August expiration. So it's basically the same quantity, just expressed in a different way. And as you can see yourself, the price over the last 2 years is slightly elevated. You can see that the current value is in the right green field between 75th and 95th percentile. And that's probably the reason why people are starting to look at bearish strategies on natural gas. So it does make sense in the short-term perspective. When I switch to the 5-year history and the 5-year distribution, you can see that we are still slightly, maybe very slightly overbought, because we are roughly at 75th percentile or close to the 75th percentile. So even from the current price is slightly elevated even from the perspective of the last 5 years. However, when I switch to a longer term view, I mean the last 20 years, the situation is entirely different. You can see that the current prices are very low. We are roughly about or close to 25th percentile. We are roughly at the left boundary of this red field. So the prices are very cheap from the long-term perspective. And as I told you, I expect a mean reversion in the long term. I think we will witness higher prices of nat gas over the next few years. The situation from the first decade of this century might be a good inspiration. You can see that prices around or even above $6 for this expiration, for the August expiration, were totally normal back then, which is something unimaginable right now. And let's also take a look at the January expiration. As you can see, the short-term picture is rather similar. We are in the right green field, so the market is slightly overbought in the very short term. However, on the 5-year distribution, we are well in the red field, which means that the market is neither overvalued, neither undervalued. And when I switch to the 20-year distribution, you can see the same picture as on the August expiration. The market is simply, or the price is simply very low from the long-term perspective. And you can also see that the price of this winter expiration tends to spike even higher than we saw on the August expiration. You can see peaks well above $10. Here is 14, here is roughly $15, while on the August expiration the highest price was roughly above about $13. So that's totally normal, because the greatest demand for natural gas is in the winter. And I'm not saying that the price has to reach such levels in the next few years, or that it has to jump higher immediately. And by immediately, I mean this year or next year. We are talking about the long-term outlook. But if I take a look over the next few years, I think we will definitely go well into the red field, and I expect prices even somewhere here around the 75th percentile, which is above $6 on this winter January expiration. This is something that we will see over the next few years. It will happen. The third chart is the so-called Widowmaker spread. It's called Widowmaker because it's very risky, very volatile. It's the spread between the last winter season expiration and the first off-season expiration. That's the reason why it is so volatile, because as I told you, it's more like a spread between two different commodities. And I tend to use spreads in general for valuation analysis because, unlike the underlying, they are mean reverting. Well, to be honest, natural gas is somewhat special because, as you can see, it's not trending as much as other commodities. I used to say that it behaves more like VIX futures, which means that it tends to stay low or close to its base with occasional spikes higher that quickly mean revert back to the base. Nevertheless, the spread is still a great way how to analyze the state of the market in natural gas, and that's the reason why I follow it closely. And this is the valuation analysis for this Widowmaker spread. As you can see, it's outright overbought, it's outright expensive in the very short term. It's above the green field, which means it's above the 95th percentile. But keep in mind, it's just 2 years of data, so the reliability of this statistical analysis is not very high. It's useful only in the very short term. But when I switch to the 5-year distribution, it's still slightly overbought because it's in the right green field. And now let's switch to the 20-year distribution, and finally it looks more reasonable and more normal because the latest value is in the red field, albeit closer to its right boundary. So it's true that there is an opportunity in natural gas. There is a bearish opportunity in natural gas. The Widowmaker spread is the prime example. On the other hand, as I also told you, I think many people, many traders have a lot of misconceptions, especially about the long-term situation in this market. The problem is that the majority of people I interact with or I see on Twitter or elsewhere, they tend to play the same game no matter what. They tend to trade bear spreads in the same way they've been trading them over the past 10 years. And to be honest, it was a very profitable strategy here on natural gas. So they have a point. But as I told you, the game has changed. The natural gas or the energy market in general will look totally different over the next 10 years than it was over the past 10 years. And most of these people fail to react. They fail to adapt their strategies to this changing environment. But there will be a reality check. And it's already happening in some other markets like grains. We've been telling you for many months that the situation in grains is difficult, that we are not interested in shorting grains. And the bear spreads that used to be a great strategy there will not be behaving the same as they did over the last decade. And it doesn't mean to abandon this strategy at all, but it just means to adapt to the new reality. Nevertheless, many people I follow, they just load up bear spreads like they used to before, and that leads to losses. But let's get back to the natural gas. Let's take a look at interesting strategy that might be very good over the next few years, very profitable. As I told you, we expect much higher prices, not just of natural gas, but also other energies. But it doesn't mean the nat gas market will be in backwardation all the time. On the contrary, I think the contango will still prevail. That's the nature of the natural gas market. Maybe the LNG export will change this, but I think it will just make the contango weaker and it won't disappear entirely. Which means that bear spreads will still be a valid strategy here on this market. But you will have to be more active, and you need to trade this strategy at the right time. Such situations happen when the market becomes truly overbought in the short term. And you also have to take elevated risk into account. So, as I told you, you will have to be much more careful and much more active in trading this strategy. Is the current situation a great time to deploy this strategy to enter bear spreads? Well, into some degree, yes. The truth is, the market is not overbought, at least not by some huge amount of positions, because you can see the speculative COT index is rather neutral and the hedgers are somewhat net short, but still far away from the extreme readings of the last two intermediate peaks. So this is not an extreme. On the other hand, as you saw from these distributions, the market is overextended in the short term, especially when I analyzed the widowmaker spread. And this strategy, this analysis is perfect for spotting these opportunities to evaluating the overbought or oversold market, because when you take a look at the distribution, you can see that we are right at the edge of this cluster of high bars, and it's very likely that there will be some resistance. Something similar is obvious here on the 2-year distribution. The 0.4 level is a clear resistance, and it's well observable even on the price itself. We are approaching the $3 resistance here on the 2-year distribution, and it's also visible on the 5-year distribution that the $3 level, this last tall column, is acting as a resistance. You can also take a look at the longer term distribution, but that's not very useful for short term valuation analysis. So this analysis, this chart can be very helpful in spotting these oversold, overbought conditions, and especially when we reach an overbought condition, that's the right time to deploy bear spreads. And now let's take a look at one such spread. It's no secret because it's a well-known and favorite combination of contracts. It's the spread between February and January contracts. You can see that the price of the spread has been going lower since roughly the middle of March, and it's approaching the support roughly around minus 0.08. So technically speaking, the support may provide a relief for this spread. The seasonal outlook is good for the spread because, as you can see, the seasonal curves are rising basically till the expiration, and the statistics are also looking very good, especially the upcoming month. They are at 80%. I mean, the 15-year statistic is at 80%, while the 30-year reading is 66%, which is great. So the month of May is great for this spread. June is roughly neutral, a sideways action, but then the spread enters a longer period of favorable seasonal tailwind. So from the seasonal standpoint, it's looking good. The valuation of the spread is simply great because when you take a look at the spread expressed in contango percentage, which is the best way how to analyze value or valuation of any spread, you can see that it's very cheap. It's below all the previous 10 years or 9 years, and there is a lot of upside. Something similar will be visible on the long-term valuation analysis, which is once again the continuous price or the spread expressed in contango percentage and using the continuous price chart. And the distribution on the top is basically the same data you see below. And you can see that both from the 2-year and 5-year perspective, the current value is on the left side, it's even below the 5th percentile, which means the spread is heavily oversold. And that's good because buying something that is cheap is always better than buying something that's expensive and overvalued. On the other hand, that doesn't mean that it cannot become even cheaper. As I told you, the longer term state of the market is slowly changing and the risk in trading bear spreads is becoming higher. So that's also something to keep in mind. So it's a good opportunity right now. There is no doubt about that. But you have to keep in mind that the risk is higher. You have to adjust your risk management and maybe even the position sizing in this spread and be much more careful and do not let the spread to run against you. And if you ask me if I would personally buy this spread, this bear spread right now, then my answer would be probably no. And I have a few reasons for this. The first reason is that I don't like the fundamentals right now. I was looking forward to the production in the US to grow back towards 95 billion cubic feet per day, and that's not happening just yet. The second problem is that the LNG exports are holding steady and they are much higher year over year. So that's also another headwind for the spread. However, I would consider another strategy that will employ the spread that's slightly different to what most of you expect. I would buy this spread but only as a hedge. And I would be hedging the exposure to the natural gas producers or basically companies associated with upstream or midstream in natural gas. This is the ETF, FCG, First Trust Natural Gas ETF. That is a good benchmark of these companies, or maybe it's not a great benchmark, because the problem is there are many companies in this ETF that are not focused solely on natural gas, and it's not surprising, because even in nature the drilling of natural gas is usually associated with crude oil. A huge amount of nat gas is produced just as byproduct of crude oil drilling, so that's problematic, but it's the best thing we have, and if you want to do better, you can create your own basket of stocks that will be made of, well, not purely, but of companies that are more focused on natural gas compared to crude oil. And there are such companies in the US. There is not many of them, but there are maybe several such companies. So that's also a good way how to handle this. And the point is, I would buy this ETF and hedge my exposure to this sector with this bear spread at this point in time. And keep in mind that this is the ETF we analyzed at the end of October, right here, that we called the ultimate value opportunity and one of the best opportunities over the next 10 years. And it's already up more than 100% since then. So definitely our intuition was right, but that's not the point. The point is, I think the long-term upside is still great. I still think there are hundreds of percent of more upside over the next several years. And that's the reason why I would consider buying this ETF. And keep in mind, it's a long-term opportunity, which means the price can easily drop to $11, maybe even $10. I don't know. Even if it drops to $9 or $8, it would be still in long-term uptrend. And I don't expect, frankly, that the price of this ETF will fall as low, but it can happen. In any case, buying this ETF and gradually building position in this ETF is a good idea, in my opinion. Of course, this is not a recommendation. It's just my personal opinion, and I can be wrong. But that's the strategy that I would personally deploy. I would start buying this ETF gradually, building and averaging as the price, or if the price goes down, and I would be hedging my exposure with this spread, because as you saw, this is a favorable, or the upcoming period is favorable for this spread, and it can serve as a great hedge. The question of how much of the exposure I would hedge with this spread, that's a matter of everyone's risk management and investment objectives. So this is something that everybody has to decide for himself. But I think using bear spread such as this one, even in the future, to hedge a long-term exposure in energy and especially natural gas, once it becomes overbought like it did in the middle of March, that's a good long-term strategy, and that's something I would personally deploy. And that's finally all for today. So thank you for watching us and see you next time.